If you look at the investments on your ledger today, will they command real purchasing power 30, 40, or 50 years into the future? Through a standard consumer lens, long-horizon certainty is an illusion. Paper fortunes can be wiped out by systemic panics and localized regulatory changes in the blink of an eye. Yet history tracks specific, non-linear asset classes that have successfully retained their value through world wars, times of severe inflation, and the collapse of empires. Building generational wealth requires moving past retail trends and anchoring your net worth in these 5 structural pillars. The first pillar is sovereign real estate. This asset bypasses paper market volatility by combining a financial vehicle with a fundamental human survival need, physical shelter. This graph tracks the median single-family home price, scaling from a $165,000 baseline to $420,000. Real estate also offers a multi-tier yield. Monthly tenant cash flow chips away at the mortgage, allowing the asset to self-amortize while value climbs. Because you cannot have real estate without controlling the acreage it sits on, the second pillar is finite geographic land. This is the oldest profitable asset class in human history. This comparison shows the difference in supply. Governments print currency indefinitely, but the planetary supply of land is fixed. Unimproved acreage gains value passively. As municipal infrastructure like roads and power grids expand around it, the land's internal valuation rises. Controlling physical acreage and housing provides a hedge against currency degradation because growing global demographics will always require geographic space. The third pillar is blue-chip contemporary fine art. The ultra-wealthy utilize works by artists like Pablo Picasso as a sophisticated private bank account that exists outside the traditional financial grid. High-end art is decoupled from standard systemic laws. It maintains zero correlation to corporate profit drops, interest rate adjustments, or central bank interventions. This asset also unlocks liquidity through collateral. An owner can place a masterpiece in a private vault to secure a credit line, accessing cash without triggering taxes associated with selling the work. Over a trailing 30-year window, blue-chip art, including works by Jean-Michel Basquiat, has outperformed the S&P 500. Modern fractional equity syndications have removed the multi-million-dollar entry barriers to this market. Retail investors can now acquire precise shares in these masterpieces, storing them in tax-free Freeport facilities. As long as civilization values culture and history, fine art remains a refuge for preserving capital when traditional markets are unstable. The fourth pillar consists of dominant enterprise equities. These are multi-billion-dollar monopolies, like Amazon, that function as the mandatory utilities of modern life. This chart tracks the compounding velocity of these networks. A $1.50 split-adjusted entry into Amazon in 1997 scaled into a resilient $196 valuation baseline today. During economic downturns, these companies use their immense liquid reserves to acquire distressed competitors, expanding their market share while others are forced to retreat. The fifth and final pillar is sovereign precious metals. Physical gold and silver represent the most durable form of decentralized wealth preservation across millennia. This logic matrix contrasts the risks. Corporate equities are exposed to earnings drops, and fiat reserves lose value to inflation. Physical gold, however, carries zero counterparty risk. It is an independent store of value. This creates a consistent demand for safe haven assets. Global central banks actively stockpile gold to protect national economies from debt spirals and geopolitical conflict. Tech monopolies provide the digital scale for modern wealth generation, but physical metals provide the baseline security against systemic collapse. Historical data only provides value if you implement a personal allocation strategy. Your next move depends on a single variable, whether you currently command more or less than $100,000 in liquid capital. If you are above the $100,000 threshold, you should focus on automation. Move excess margins away from volatile trends and into low-cost index funds and core infrastructure equities. If your liquid net worth is below $100,000, your primary asset is your time. Trade your available hours to master high-income technical skills that can be funneled back into building a portfolio. Choose to move from a spectator holding paper cash to an investor building a durable asset engine. Hit the subscribe button, activate the bell, and type the word #future in the comments to declare which phase of this strategy you are executing next. We will see you back here next time.